Buhari has presented the proposed 2021 budget to the joint session of the National Assembly. The 2021 budget, titled Budget of Economic Recovery and Resilience, sets a total budget of 13.08 trillion naira. The recurrent expenditure is estimated to be 5.75 trillion naira, while the capital expenditure is pegged at 3.33 trillion naira. The federal government have proposed the debt servicing of 3.12 trillion naira for the year 2021. Let's look at other key assumptions. The estimate for the gross domestic product was pegged at 3%, inflation rate estimated at 11.95%, indicating a possible rebound from recession. The total aggregate revenue is pegged at 7.89 trillion naira, while the trade fiscal deficit is estimated at 4.49 trillion naira. Proposed exchange rate for the year 2021 is set at 379 naira to a dollar. The oil benchmark is pegged at $40 per barrel per day, and oil production is for 186 million barrels per day. Joining me live via Skype from Victoria Island, Lagos, to see through the performance, of course, later of the market, and I'm talking about the budget first, which is the most important and the biggest story in the world of business, is the Chief Executive Officer of Cowrie Assets Management Limited, Mr. Johnson Chukwu. Thank you very much for your time, Mr. Chukwu.
Thank you, Tolu, for having me.
Yes, so the budget has been presented to the Joint Assembly. Now, apart from being a bit timely that many have said, what more do you make of this spending plan, Mr. Chukwu?
Well, the first that came to mind to me is that the budget is coming early enough for the National Assembly to review it, make necessary amendments if there's any, and then pass it for the president to sign it into law ahead of the end of this fiscal year. So, in effect, we are gradually reverting to a budget period of January to December. But when you go to the individual figures, you did mention that the budgeted expenditure is 13.08 trillion naira. Budgeted revenue about 7.9 trillion naira. Deficit about 4.5 trillion naira. But some of the things that easily come to mind is that the budgeted non-debt recorded expenditure is 5.6 trillion naira. If you add that to the debt service of 3.12 trillion naira, you're dealing with about 8.7 trillion naira in recurrent expenditure, which is higher than the 7.9 trillion naira that the government is budgeting for revenue, for its revenue. So in effect, the recurrent expenditure this next year will be higher than the total government revenue next year, assuming that the government is even able to achieve the targeted revenue of 7.9 trillion. So that for me is always a concern, because in effect, we're going to borrow partly to fund recurrent expenditure before we talk of the about 3.8 trillion naira they want to spend on infrastructure. So you can see clearly that almost 5 trillion naira will be required to be borrowed in order to actually spend on infrastructure. So those are, for me, are the concerns. And I have advocated repeatedly that we need to review our strategy for infrastructural development. That as it stands today, our revenue is not strong enough as to support the level of infrastructure and the speed at which we want to develop infrastructure in the country. And we should review and possibly adopt alternative infrastructure development approaches or funding arrangements, including the public-private partnership arrangement. Otherwise, we're going to continue to struggle to build infrastructure. I am doubtful if the government can achieve a 7.9 trillion naira revenue this year, next year, given that the economy is just coming out of recession. Most of the revenue heads, other than the revenue projection from oil and gas sector, may be difficult to attain next year. And even if you cast your mind back to 2019, total federal government revenue in 2019 was just about 4.12 trillion naira. At the end of the first 7 months of this year, the Minister of Finance said that the projected revenue prorated for the first 7 months had underperformed to the extent that we only achieved about 68% of that projected revenue, had underperformed by about 32%. I know that next year, in terms of economic activities, may be an improvement over this year, but I doubt if the revenues could grow to attain a 7.9 trillion target.
The revenue shortage remains a major challenge as government continues to seek new ways of getting funds. Now, how do you see government raising funds? Do we still resort to borrowing? Already we are doing more than 30 trillion naira. Where do we go from here?
Well, I think the National Assembly is already considering a 4.1 trillion naira borrowing for the government for 2020. If you look at the medium-term expenditure framework. So in effect, we expect another additional 4 trillion to be added to our debt profile by the end of next year, assuming that is met. But most importantly, the government has projected 3.12 trillion naira in debt service. I think we're actually going to see that given our current debt debt status. But that alone accounts for more than almost 30% of our total projected expenditure. But if you compare that to the about 7.9 trillion naira, you are dealing with clearly more than about 35% of our government revenue will be spent on debt service, assuming that is achieved. But if you cast your mind back, if you just stay back to what was achieved last year, where total debt service was about 2.45 trillion, and then total revenue was just about 4.1 trillion, then it simply meant that last year we spent more than 50% of our total revenue on debt service, which I suspect will still be the case this year. And as we mass up more debt, the debt service to revenue will continue to increase. I had already done analysis to show that our current expenditure is going to be higher than our total revenue. And we're going to be borrowing to meet the current expenditure, even in 2021, when we're even projecting an overly optimistic revenue. So for me, I had mentioned earlier that we really cannot continue to fund infrastructure and see that this country will develop at the speed we are all hungry and looking forward to. Tolu, let me remind you that the president said that Second Niger Bridge is about 42% completion. And that bridge has been under construction for the past 5 to 6 years. So if in 6 years we've achieved 42% completion, then that means we have to do another 8 years at the same rate of funding, or maybe another 10 years at the same rate of funding to be able to complete that project. If we had allowed the private sector, when it was given to Julius Berger and the Nigeria Sovereign Investment Authority to fund it, today that bridge would have been effectively used, and no money would have come out of the public purse, and they would have been told, and they would have by now been recovering their investment. So that has been my position, that we need to look at commercially viable infrastructure projects and allow private sector to come in to support their development, while government focus on largely social infrastructure that are not viable for private sector investment.
Okay, Mr. Johnson, before we continue the discussion, let's look at these figures. Today, we're looking at the market, major advances, Total. That's talking about the stock market now and how that also affects our economic growth one way or the other. We have Total, Eternal, International Brewery, Custodian, Boa Cement. Main decliners are Guarantee Trust Bank, PZ, US, UCAP, ETI, and Julius Berger. Now, the market, the performance for some time now, despite the COVID-19 challenge and all that we've been seeing, what do you make? Some say that it's self-rewarding with huge gains despite these challenges.
Well, let me start by speaking on the gainers. You did mention Total and Eternal. And as you know, these are the downstream oil and gas operators. What is happening is that investors are reacting to the statement, to a definitive statement made by the president at the budget presentation yesterday, where the president said the government is going to stick to its new policy on deregulation of the downstream sector. So investors are gradually beginning to take positions, knowing fully well that government is not going to backtrack on that policy. You also mentioned the likes of Boa Cement, and these are companies in the construction industry. As we move towards the dry season, we know construction will pick up, demand for their products will also, it will also reflect the demand for their products. But back to the larger issue on what do we make of the appreciation we've seen in the equities market. If you look at what's happening in the securities market, which include the fixed income space and the equity space, what we've seen in the past couple of months is that yield on fixed income instruments have actually bottomed out, have actually dropped to below 2%. Even 364-day bills are trading below 2%, and 90-day bills are trading at around 1%. So investors are now beginning to underweight their portfolios on fixed income and overweighting them in equities. We are going to see a shift from fixed income instruments because of the very low yield to equity instruments. Most importantly, some of these equity instruments, some of these quoted companies are giving returns, dividend yield of 5 to 7%, which is higher than the return you expect on fixed income instruments. So, and I think that as long as this yield environment is sustained, you'll continue to see a movement of investment to the equities market. Of course, once in a while you will see profit taking, as we saw the last 2 days, where investors wanted to lock in on the huge profit they made in the preceding 2 weeks. But ultimately, we should expect that the equities market will remain strong or relatively strong within the context of how the economy is evolving. Whether the economy is recovering at a faster rate or the economy is remain weak. But as long as we are seeing economic recovery, we should see investment go to the equities market in an environment where fixed income yields are quite low.
The coronavirus pandemic affected companies and businesses that are quoted. Would you say the firms are already recovering from the pains of this pandemic? And at this time, can we welcome new products, especially derivatives, at the market?
Well, let me start from the second part of your question. Market development is a continuous process. We're already seen a number of derivative products in the market. Product development, product introduction will continue. The key thing we need a vibrant market to take on these products. But as it relates to the corporates affected by COVID-19, I would say that it looks like, from all indications, that for those of us in Nigeria or in Sub-Saharan Africa, that the worst is behind us. We are not likely going to see a second wave of infection in Sub-Saharan Africa. There's obviously, which I'm not in a position as a non-medical practitioner to speak on, but clearly there's something about Sub-Saharan Africa or Sub-Saharan Africans that has defied the predictions on the calamity that will befall us as a result of this COVID. So we are turning the corners. The economies are reopening up. Schools have reopened. Hospital industry are reopening. Hotels have reopened. The local flights have all reopened. And you can't compare a business environment where there was a total lockdown we saw in the second quarter of this year to an environment where economic activities are opening up and people are beginning to have resumed going about their business. So the business operators, the quoted companies are likely going to see an improvement in their earnings and possibly an improvement in their profitability. And the worst case scenario, a reduction in their loss position for those who made losses during that period.
I want to ask you this question. Those that have money that they want to put their monies into the exchange, what would you say? Is it attractive at this time? What sectors should they look at?
There are several sectors that are quite vibrant. I just mentioned the cement industry, or the industrial goods and building material subsector. They are quite vibrant because we are moving towards the dry season. You also look at the banking sector. The banking industry seems to have weathered fairly well the COVID-19 induced economic crisis. And a couple of banks that have declared half-year returns or half-year dividend are giving returns of dividend yields above 5%. So remember, when you have to make an investment, you have to look at what are the alternative investment outlets available to you. The fixed income space is a no-go area for investors because the return, in as much as your capital is assured, the return is too low. So the equity market will remain, for now, the best next option. And a couple of sectors, the banking industry is there, the consumer goods industry is there, the industrial goods, the agricultural sector has actually outperformed the market. You see the few quoted companies from the agricultural sector have outperformed the market. Beneficiaries of the COVID-induced social changes, the telecommunications sector will also remain very attractive sector for investors.
Well, a good way to leave it now. Mr. Johnson Chukwu, let's project for the new week. As we move on in the new week, what are your expectations on the economic side and also playing up what will be playing out at the exchange?
Okay, let me start from the macroeconomic environment. I think, like I told a couple of friends, that the government is beginning to take the right decision as it relates to managing the economy. I was quite elated when the president said the government is not going to roll back its policy on full regulation of the downstream sector and allowing market forces or cost-inflative tariffs as it relates to power consumption. I was quite happy with that. I think the government is going to straight that. The National Assembly said they are going to start debate on the petroleum industry bill in October. I think October 21st or thereabout. So these are policy changes that we should expect. Also note that Fitch Rating Agency just has improved, changed their outlook on the general economy from negative to positive. That also will encourage investors to come back. The central bank on its part is pushing to clear the about $2 billion areas of foreign exchange demand and have promised within the next 16 weeks they will be able to clear that. If these things are done, we should expect that the economy will continue to recover. And as it stands today, we should, like I said earlier, the worst is behind us. As it relates to the exchange, we could see profit taking in the first few days of next week, but ultimately, investment will flow back into the equities market because it is the next most viable investment outlet in the country today when you compare returns on other securities instruments.
Mr. Johnson Chukwu is the CEO of Cowrie Assets Management Limited. Thank you very much for your time. It's always great to have you on the show.
My pleasure.